Sora 2 launched as the most advanced video generator ever made. The demos were cinematic. The hype was enormous. And within 30 days, user retention dropped to 1%. Around the same time, Microsoft reported what most companies would call a fantastic earnings quarter. Revenue up 17%. Azure up 39%. $81 billion in quarterly revenue. And the market erased $360 billion of its valuation in a single day. That is not a rounding error. That is not volatility. That is fear. So what exactly is happening in AI right now? Why are the CEOs who built this boom suddenly asking people to calm down? And why does it feel like the tone has shifted from triumph to justification? In January 2026, Satya Nadella said,
"For this not to be a bubble, by definition it requires that the benefits of this are much more evenly spread."
A telltale sign of if it's a bubble would be if only tech groups were benefiting from the rise of AI. This was widely reported across business outlets covering Microsoft's AI strategy. He also publicly asked people to stop calling AI slop. That's an unusual thing to say if you are fully confident the market understands your long-term vision. Jensen Huang delivered a similar message. He said, "I think we've done a lot of damage with very well-respected people who have painted a doomer narrative, end-of-the-world narrative." This came during public remarks covered by financial press after Nvidia earnings. Again, not the tone of someone riding pure euphoria. It sounds more like damage control. At Jelvix, we see this as a narrative inflection point, when leaders stop talking about inevitable transformation and start talking about perception management. Something underneath the surface is shifting. The numbers explain why. Microsoft's capital expenditure jumped 66% year over year, $37.5 billion in one quarter. Roughly 2/3 of that went into chips. Investors noticed something uncomfortable. Revenues up 17%. Cost of revenues up 19%. Portfolio manager Eric Clark summarized the concern in earnings coverage, noting that if costs keep rising faster than revenue, that becomes structurally problematic. The issue is not that Microsoft is losing money. The issue is that AI may not yet justify its cost curve. Oracle announced plans to spend $50 billion on AI in 2026. Its stock dropped after the announcement. Reuters described investor concern about the rising costs of Oracle's AI push and the time required to see payback. The market is no longer pricing vision. It is pricing timelines. Then there is Nvidia and OpenAI. Reports last year suggested Nvidia could invest up to $100 billion into OpenAI. More recent coverage clarified that any such agreement was non-binding and not finalized. The Wall Street Journal reported that Huang privately criticized what he described as a lack of discipline in OpenAI's business approach and expressed concern about competition from Google and Anthropic. When your biggest supplier questions your discipline, that is not noise. That is structural tension. OpenAI reportedly surpassed $20 billion in annual revenue in 2025, up from $14 billion the year before. But projections cited in financial reporting estimate cumulative negative cash flow of over $100 billion before profitability. Some analyses suggest profitability may not arrive until 2030, with potential liquidity pressure by 2027 if capital markets tighten. This creates a circular ecosystem. Cloud providers and chip makers fund OpenAI. OpenAI spends heavily on cloud and chips. The suppliers recycle the capital back into the customer. That flywheel works only as long as investor confidence remains intact. Government pressure adds another layer. Senator Elizabeth Warren wrote publicly that OpenAI had committed to enormous spending, despite not yet turning a profit, and appeared to be seeking government assistance should it prove unable to pay its bills. OpenAI denied bailout intentions, and its CFO walked back comments suggesting taxpayer backstopping. But the mere existence of that discussion shifts perception. When both political parties hesitate to support a trillion-dollar infrastructure build-out, markets pay attention. Now add user behavior to the equation. Sora's retention collapsing to near zero within weeks signals something deeper than product bugs. It signals novelty fatigue. Suno reportedly attracted millions of users for AI music generation, many of whom churned after the initial excitement. This is what some commentators have called AI tourism. Users arrive, generate 50 images, write a few songs, feel the dopamine spike, then leave. At Jelvix, we believe this is the real stress test, not benchmarks, not model size, not GPU counts. Daily habit formation. Microsoft's Copilot numbers tell a similar story. Around 15 million paid Copilot seats out of roughly 450 million, Microsoft 365 seats. About 3% adoption, after tens of billions in infrastructure investment. That is not failure. But it is not universal transformation either. It is early integration, and the market had priced something closer to mass behavioral change. Search interest in AI has also cooled from peak levels. This does not mean AI is dying. It suggests we are moving down the Gartner hype cycle from inflated expectations toward disillusionment. At Jelvix, we see this as normalization rather than collapse. The consumer spectacle phase is fading. The enterprise integration phase is beginning. The key divide now is between two visions. The first says AI will replace entire categories of labor and generate unprecedented new revenue streams. The second says AI will quietly improve productivity inside existing workflows. The market initially priced the first. The financials so far look more like the second. AI is producing real breakthroughs in areas like protein structure prediction, medical diagnostics, weather modeling, and scientific research. These are tangible gains, but they are narrow and specialized. They do not immediately justify hundreds of billions in capital expenditure across the entire tech stack. For that to happen, AI must become embedded and indispensable, not entertaining and viral. At Jelvix, our view is that a cooling period may actually strengthen the ecosystem. If speculative tourism fades, the surviving products will be those tied to real workflows. AI as a feature inside Google Docs, Adobe, enterprise software, radiology systems, supply chains. Not AI as a standalone toy. Is there a world where the bubble bursts and valuations reset sharply? Absolutely. Is there a world where AI disappears? Highly unlikely. The more probable outcome is compression. Expectations shrink, multiples normalize, spending becomes disciplined, growth becomes incremental rather than explosive. The interesting part is not whether AI survives. It will. The real question is who survives this transition? Companies betting on dopamine cycles or companies embedding AI into essential infrastructure? In our opinion at Jelvix, the boring incumbents with locked-in ecosystems and enterprise distribution have the structural advantage. The CEOs do not sound insecure because AI is failing. They sound cautious because the cost curve is colliding with adoption reality. When you spend hundreds of billions, anything less than a revolution looks like underperformance.
We will invest more than $30 billion over 4 years.
And shareholders are beginning to demand evidence, not promises. This is not the end of AI. It may be the end of AI tourism. And that shift will define the next decade of this industry